Welcome traders to the Polaris Trading Group PTG University Indicator Review. Today's indicator review is one of my favorite. It's called the Position Sizer Reward Risk Tool. And what this indicator does is it calculates position size and R value targets. This tool auto-calculates position size based upon account value and percentage risk parameters input by the trader. It displays an entry price, a stop loss price, a risk-free level, and up to 3 optional price targets with R value or reward values. If you are serious about trading, then this tool is an essential addition to your trader toolbox. Professionals know the true value of the power of position sizing, and this is the tool that you're going to need to be on par with the large institutional trader. Let's take a look at how it works. Okay, we're taking a look at the S&P E-mini here on a 1500 tick, but it doesn't really matter what chart you use. It can be used on any chart size, any chart type, because what we're doing is we're calculating risk-reward values based upon entry price and initial stop values. All right, so let's just take an example here. As you can see that the market had made quite a nice move up during this session, and let's just say that as an example that you think that the price here up at the 1858.59 level has pretty much reached its potential, and there's now new potential for a pullback in price or even a deeper sell-off. And so with those assumptions, you want to take a short trade here, all right? But you're not sure how many contracts, all right, and what type of risk-reward opportunities are presented to you. So let's just say simply that you want to take a short here at approximately the 1858. So with this particular indicator, all right, you can see up here on the right-hand side it says account size $30,000 with a risk percent of 2, which means for each trade the maximum percentage risk is going to be 2% of a $30,000 account. Now those values there are adjustable, and we'll show the input parameters just in a moment or two. So let's just say again in our example we wanted to short 1858. So what you would do here is simply right click, and the menu comes up and you say set entry at 1858. Now what we want to do is we want to place a stop order. So we want to place a stop order, at or slightly above the high. Okay, so we'll put the stop order about 59 3/4. Now that's going to automatically calculate your risk within the 2% parameter for $525. This is also going to show you here that at an entry price of 1858, you'll be able to, within the context of your risk parameter, short a maximum amount of 6 units. Now, units can be multiple contracts or they can be singular contracts. We'll assume that there are singular contracts here, and so that's 6 contracts that can be shorted at 1858. All right. Now, the important part of this risk-reward tool is to determine what is the risk-free level at which if price moves in my direction, that I can get risk-free on the entire position or at least a partial position. Okay, so this indicator automatically calculates that risk-free level, and that's simply that RR level is a 1 value unit. So in essence, if you were to take off 6 contracts at the 1856 quarters, you would make a dollar amount equivalent to the maximum risk put in there. In this case, $525. All right, so that's what we refer to as a 1-to-1 reward risk unit. Now we have further options. Let's just say if you have greater potential that you think this price can move down to. Let's just say you want to move down to the prior pivot here. Well, there's an optional choices here in the menu where if you do right click again, you have 3 choices of target 1, target 2, target 3. Now these are optional. What is not optional is your stop loss and the risk-free level. So those are automatically calculated and painted for you. So in this case here, let's just put a price target here at approximately the low, and let's just say you say, you know, perhaps it can get down to this prior even a little bit lower pivot low. So let's just put another opportunity there for target 2, and then ultimately it's just to say for, you know, hoots and hollers, you think you can get down here to the 1850. So these are all potential targets. Okay, and as it goes down, as the targets are filled in, you can see that the RR value is 1.86, so that means 1.86 times your initial risk. If you reached target 2, this will give you an RR value, or a reward risk value, of 2.86 times your initial risk. And then ultimately here at target 3, clearly a very, very great trade if this develops this way, at a 4.5 times your initial risk. All right, so those are planning. And again, this is very powerful tool that professionals use. They want to know position sizing. They want to keep each and every single one of their trades uniform in terms of risk. Okay, so if you're a professional trader and you're saying, you know, I want to keep my risk within the context of every trade $500, or if you're a smaller contract trader, you know, you adjust your count size, and you say, you know, I want to keep my risk within a maximum of $200, okay, for every trade. Now that's the important part of position sizing, is that your stop losses must be uniform. All right, most uninformed or novice traders, they loosen their stops, and again, it gets them into all sorts of trouble. Okay, so, you know, power of position sizing is really important, because this is where you can really capture some alpha, some R value, and to really grow your account. So let's just see how this trade ultimately unfolded. I'll just move the cursor a little bit forward, and you can see right there at 1856, this would be the point at which, if you sold 6 contracts here, you could take a partial off. So which means you could take 3 contracts off, 2 contracts off, some portion of that 6, and then that would get you to a risk-free or potentially risk-free level, meaning that no matter what happened at that point, if prices rocketed back up, okay, you've protected your capital, and that's, you know, your responsibility as a trader, all right, to protect that capital. All right, get to that risk-free point. And then beyond that, once you've reached that risk-free point, you want to be managing your trade. All right, so let's just see how it all unfolded here. Prices again went lower, perhaps just tagged the low here, okay, at about the 54.75s for a target number 1. There you go. Pushed right through, target number 1 hit. All right, and then as it goes lower, okay, again, looks like we got a little bit of a bounce. Okay, back up. Okay, and again, at this stage, you'll have taken, you know, 2 portions of your position off, and, you know, there's no way, you know, that the market can take that money away from you now, those profits. Okay, now it's just a matter of managing the balance of whatever open positions that you may have. All right, so market pushes up, pushes up, pushes up, pushes up, pushes up, pushes up, and then ultimately looks like boom. All right. Shoots back down. Let me just adjust the chart here. All right, shoots back down, and then even further. Okay, not sure whether or not we're going to get that 1850. There we go. Boom, 1850 gets hit. Okay, and so it all started up here with an idea that the market had topped out, and you were willing to accept some initial risk to take a short position. And again, this works in reverse on the buy side as well. So it always starts with an idea, trade idea, and then how many contracts, if I want to initiate that idea, okay, how many contracts can I trade given a certain risk parameter? All right, so the important part here is keeping your risk small and under control. Look to get to that risk-free point here, okay, and then at that stage we look to hit some targets. And again, these targets are optional. They're not arbitrary. They're optional based upon your own analysis and range calculations and so forth. So in this case, you were able to get, you know, all 3 targets, in this particular instance. Now this seems to be a perfect example, but there are many, many times where, getting to the risk-free level being that most important takes a lot of the psychological pressure off of the trader. Okay, so that's how you do it. Let's take a quick look at the parameters here. Okay, and taking a look at the parameters here, you can see the account size. These are, again, this is all optional. $30,000, you can make it whatever you want. And then if you decide to use a maximum risk defined by, you can either be percentage or you can be dollars. So if you have a dollar risk, you will have to put in a specific dollar amount. So let's just say you call that $200. Okay, and then the risk percent here won't really matter because you only want to maximize your risk to $200, and simply just input that parameter, and then as you can see here, it automatically changed from 6 units down to 2 units, and you can see up here in the top right hand side it says max dollar risk $200 per unit. Okay, so this is truly one of my favorite indicators. It's a new indicator we recently released, and into all 3 charting packages. And professionals know the power of position sizing, and you should also. And this is one of my favorite indicators. It's a very, very powerful indicator, and this is one that is perhaps a mandatory part of your trader toolbox. Hope this helps, and good trading, everybody.